if you are seeing this, this is my second channel that I've decided to rebrand and wanted to use it to talk about things that I have a more understanding on that I just want people to be aware of. So that's why I kind of named it Shark Talk in a way. It's just because using my brand that I have and just using it to pivot. But today I wanted to just talk about things that you can do to just help yourself, I guess. I think I'm labeling it something like one way to help eat the rich, and this would be one of the ways. But also, I just kind of want to talk about things that I just have an understanding of that I think a lot of people just don't get to learn about. I feel like growing up, you just don't get a lot of general knowledge that everyone should be aware of, but just aren't being taught in schools. I know that the old when am I going to use algebra thing, but at the same time, like we also should be having talks about just understanding things like credit reports and things that are going to be useful in your future, especially if you're going to live in the United States. And so I just wanted to go ahead and just explain on some things that I have an understanding on. If you disagree, that's fine, but these are just things that I know. So first thing I want to talk about is eating the rich. Just an easy way to help deal with that is not using banks. And I don't want it to be like put your money in a mattress, but just use a credit union instead. Credit unions are a great way to switch because one, credit unions are nonprofit. All right. So it's just simple. They aren't here to make money. I mean, they're there to make money, but they're also not keeping the money, unlike banks. Banks are for-profit companies. Mind blowing. But they are there to make money for their investors, their shareholders. Just like any other company that's on Wall Street, banks are the exact same way. They are trying to make money off your money. So this is why you should be going to credit unions. Banks do have the upside of being more everywhere, is the best way to describe it. Wells Fargo, perfect example. Chase Bank. They are all over the country. So if you're traveling, you get your card stolen. Yeah. So it's going to be easier to go into a bank in Seattle if you're from Philadelphia and get a new debit card there than it would be to say same thing. If you're from Philadelphia, you're in Seattle and you all of a sudden can't get a new card because your card was stolen. Uh, Credit unions are more known for being for the community. So they're not going to be as popular across the country. Navy Federal Credit Union is a big one that I would say is the most popular, at least has the most brand awareness. But credit unions are kind of considered like community banks. So most of the time, credit unions will have some kind of stipulation for their members. So they have to have some kind of way to be into the credit union. Mainly it's like being in the community or just knowing somebody. Like there are a lot of credit unions that just, if you live in that state, you're eligible to be a member. If you have family that is in that credit union, you're eligible to be a member. The point is there's just so many ways that you could be a member of a credit union and just not be aware of it. But credit unions, obviously, yeah, they're nonprofits. So their main goal is if they make profit, it's going to go right back into the company. They're going to have lower rates for interest loans. They're going to have higher savings account yield accounts. Same thing with CDs. Lower interest rates on the credit cards, on the auto loans, on mortgages, so many things that banks are not going to offer as much of. I mean, for majority of my life, I was banking with a bank. I mean, being from a pretty small-ish town, like that was the only primary thing. And so obviously, why would I switch from being in this bank that I know if I ever need something, I can just go down the street and get a new one. But switching to the credit union, I was able to make more money off my money. Like I earned so much more interest off my money in my accounts than I would ever make at the other one. And they're not charging me fees for it. Some checking accounts at like banks and stuff will charge you fees. And it's kind of annoying because I have to have so much money in my other savings account at that bank. If I have less than $100 average in that savings account, they're going to charge me a fee because I'm not having enough money in that account. Whereas the credit union that I have, $5 in that savings account, that's it. I don't have to have any more money. They put that 5 on hold so I can't touch it. But otherwise, any other bit of money I have is readily available to me and I don't have to worry about accidentally dipping into the money that not allowed to touch. Like $5, that's it. My money is my money. And because of that, I've been able to divest my money more. And so they have better rates for my checking account. So I can spend my money and earn money back. Like, credit unions are good for the people. Look, if you have the money, sure, go with a bank, I guess. Go with Wells Fargo if you're not worried. Sure, if you're going to travel a lot and you're worried about fraud and things like that, sure, I can understand sticking with a big bank like Chase, like US Bank. Like, there are so many Bank of Americas. And there's a reason they're also able to have their names on billboards and on stadiums and all this other stuff, because they are for profit. SoFi Stadium, perfect example in LA. USA Bank in Charlotte. Like, they are big names for a reason, because they make money off of you. So that's just one. It's just, there's so many reasons why I think credit unions would be better for people to have their money into. But also, some people worry about things like whether or not their money's actually protected. Because, years and years ago during the Great Depression, people took all their money out because they were worried they weren't going to be able to keep it because everything was falling, right? So that's why they have things like the FDIC. The FDIC stands for Federal Deposit Insurance Corporation. It's pretty much a way to guarantee that you're going to get some of your money back that you have in the accounts. So they will back up your money up to $250,000. So if you have anything over $250,000, it's not federally insured, but anything under it, you're safe. Credit unions, exact same thing, just a different name. They have the NCUA, which is the National Credit Union Administration. Same thing, up to $250,000, but there's also not loopholes, but there's more ways just to have your money federally insured just up to the $250,000. You could go over it. There's other ways around it. I don't know if the FDIC is the same, but I would assume they are the exact same with being able to get more money federally insured. Overall, I would just like to say, yeah, usually the biggest things are banks, open to everyone. They're easily accessible because they're all over the country. Same, bank is all over the country, but credit unions have, one, better interest rates, two, more knit in their community, so they're doing more public outreach. They are giving back to their community because usually they're more close knit. They're not as expansive as like a US bank, but they actually do stuff for the community because they're community based, they're nonprofit. They are putting money back into it to help reinvest for the people in the community. But then, yeah, you'll see stuff for Navy Federal Credit Union, one of the biggest credit unions, if not the biggest in the country. Now, same thing, they obviously have membership requirements. Navy Federal, kind of an explanation there that you need to either have served or some relation in serving. But that's kind of the same thing with credit unions. You have to have a way in to be a member in that community, which kind of segues me into my next point, which is credit reports. Credit reports, I feel like is not brought up a lot when you're growing up because they don't kind of explain to you what credit reporting kind of is, how do you obtain it and build more off of it, and how do you keep it at a high overall score. So like the max score is 800 and something. If you were even close to 800, you're going to get the best rates overall. I think about 780 and above, you're pretty much good. You're set. You're going to get the lowest rate possible. But there are a bunch of requirements for getting that high of an interest rate. So credit is based off, think of it like a class where a teacher will say, this test is worth 50% of your grade, right? So you're going to want to focus on that specific thing. Well, credit reports are kind of the same way. Credit report obviously is split into tiers, percentages. Based on those percentages, that's how you'll get the report, right? So one thing about the credit score that is important is length of credit. Now, there's plenty of ways you can obtain credit. One, loan. Two, credit card. Okay, not as many things as I thought, but those are like two of the main things. For me, one of my first things I ever obtained was a credit card. I got it probably when I was 19, 20. And that is my longest tenured thing of credit, right? I've had it for the most many years. I've had an auto loan, but it's not as long. But also, you never want to get rid of that card is the best way. You never want to close out the credit because length of credit is very, very important to your credit score. So I've had my credit for a long time. And one thing that's great is that you can, once you're 18, companies will hound you to get credit cards. which is a double-edged sword. One, you can establish your credit history right away. That's a great way to do it. Discover is a great one because they don't offer fees. You can get a credit card, and for me, when I started, they would slowly increase my credit limit, which is also a really good thing if you're smart with using your credit card. Now, I just want to state, I was not smart with my credit card right away. All right, I have built my credit up, but it was not good to start. Now, credit length is great. Credit utilization is also important, which is how much I'm spending on my credit cards. So if I have a $500 credit card and I have $300 put on that card pretty much at all times because I'm always spending it and paying it off to $300, it's going to say I have a credit utilization score of 60% because I am maxing out 60% of my credit that I have, and that's bad because they do not want you to be over 50%. 50% is kind of like that threshold. They never want you spending so much money, but they want you spending money, but they don't want you spending so much money is the best way to describe it. I would always say never be over 30%. So if you have a $1,000 credit card, never be over $300 on that credit card. That's where I would kind of check and pay, check and pay, check and pay. Because if I have the funds available to pay for it, pay it off. Credit cards base themselves kind of like how CDs and savings accounts do. Every day the interest accrues. CDs, savings accounts, depending on how much you have in those accounts, they will pretty much be based off of think of it as every day it accrues 1/30th of how much the percentage is, right? And so then each day it accrues that amount, and then based off those 30 days, based on the interest rate, that's how much money they're going to give you. Credit kind of does the same way. If you put $100 on that card and you wait up until the day that it's due, it would have accrued interest on every single day that you waited. Not good, because you say you make your payment before it's due. They usually wait 2 or 3 days until after the due date is over. When they redo your statement, that's when they'll send the statement out saying this is how much you spent on your credit card. But then they will hit you with the interest after those about 3 or 4 days when they mail it out. So then, because you had all that money sitting on that card, it accrued interest. Now you're slapped with the interest. Always pay the card if you can. Pay it down to 0. This is why I do not like credit, because they also will say, when they check it, if it's always at 0, they're not utilizing their card. That means they're not usually using the card. And if they're not using the card, the best way to explain it is they want to see that you're using the card. So when they check your credit, say they check your credit card and they see that you have no balance on it all the time, they're going to be like, well, they're not really using the card. But if you have some money on the card, when they check it, they're like, they actually are using the card, but they're not over at that threshold, that 30% threshold. That's good. So they will increase the credit report or credit score. Now, I keep saying credit report. But speaking of credit reports also are a factor in your credit score. So if you're going to go and take out a loan, they will do a thing called a hard pull on your credit. That is when I don't know why it's even a thing, but they will do a thing called a hard pull. So they will pull up all the details on your credit card. So they will look up how much is being spent on your cards. They will look up any other previous loans that you have, if there's any delinquencies. So if you have ever faulted on any loans, they will pull up everything and they can see it all. Whereas a soft pull, it's pretty much like peeking, barely cracking open the door and peeking in and see what the credit score is, right? You're not really taking a look at everything. You're just kind of seeing what the credit looks like, shutting the door. Whereas the hard pull, it's pretty much kicking down the door and you're pretty much ice, just spamming through the house trying to find anything that you can find on this person. I don't know why I made an ice reference. Fuck ice. But beside the point. So the thing is you do not want to do so many hard pulls. All right. I would say 2 max a year. So do not do more than 2 a year. I had my credit pulled November of 2024, right? And it just now came off of my credit. Because they keep it on credit, they keep it on file for a year. So you do not want to do too many pulls. If you get it pulled somewhere like a bank or a credit union, that is when you want to go back because that credit pull will last for so long. So say you go to the credit union, you get your credit pulled for an auto loan. They say they can't do anything at this moment. And then instead of going to them, you go somewhere else. Well, they're going to pull your credit too. That's going to hard pull. That is going to overall affect your credit. Whereas, say you get your credit pulled, couldn't do the loan. Well, you decide, well, maybe can I open a credit card? Well, they can take a look, go back to that credit union because they can still use that credit that they pulled without doing another pull and affecting your credit score. And same time, credit cards are a different type of credit than, say, a auto loan, because an auto loan is what is called secured debt. They know how much is here. They know how much you have to pay. They can be sure that this is how much they're going to get from you, and they know how much you're going to be spending. Whereas unsecured credit is pretty much they're like, hey, you can spend $25,000, but we don't know if you're going to spend $25,000 because you could just max it out and then just flee the country and never make a payment on this again. So they're always a little bit more hesitant on giving you a large balance on a credit card, whereas auto loans, they might do a little bit more willing to do a higher amount. But also, credit cards also kind of depends on how much you make, because you can only go past a certain threshold for how much you make in a year. So if you only make $1,000 a week, actually, it's not terrible, but they can only do so much of a credit card based on the percentage of how much you make in a year. So keep that in mind. But then again, there's companies like Discover that if you're using your card a lot, you can have it set to not do it, but they can keep slowly give you more credit limit, a higher credit limit. I ended up with a very, very large amount on my credit, and I have never even thought about having them stop it, because all it's doing is giving me a larger credit limit. So I'm not ever going to go over that 30% on that credit card. So it will look good for me on that credit. Also shows how long I've had that credit, increases my credit length. Say an auto loan is your biggest credit, like your credit term limit. Well, you're eventually going to pay off that auto loan. And say you just opened a credit card 3 months ago. You've had this auto loan for 5 years. You finally pay it off. Boom. It is now going to say the longest term that you have in credit history will be 3 months, because you've only had this credit card for 3 months, because the longest thing that you had before that is now paid off and gone. So that will negatively impact your credit. So credit has a revolving door is the best way to describe it. Credit, you need to have something that shows long-term credit history, but you also need something that has a large balance so that you can not go over the credit utilization, right? But you also need to be using it all the time, because if you use it all the time, it shows that you're actually showing you're using the card, so they will be happy in that aspect. But also you don't want to keep money on it all the frickin' time, because then you're going to accrue interest, and the interest rates nowadays are fucking insane. All right, minimum 20%. All right, minimum 20%. All right, I had to put my mom on my credit card. All right, I don't think you guys understand. When my mom passed away, 2014? Yes, 2014, right? I didn't have the funds readily available for her cremation, so I had to put it on my credit card. Now, mom was expensive, and so I had a decent amount of interest put on there because I couldn't just pay her off in one fell swoop. So I paid a little bit more technically than what I had to, but slowly got her, and I got her paid off. But that is also a great reason why you need to have a large credit card amount, because I could put a large amount on my credit card, and I also knew that I was not going to go over that 30% threshold. And so it was not going to negatively impact my credit because she wasn't that high on my credit card, but I was accruing interest. So that was bad for me, but otherwise wasn't as bad. That was really the only hit that I was taking, was that I had interest that I was going to pay. But yes, I had a high enough credit limit that it wasn't going to bump over the credit utilization that would negatively affect my score. So it was a win for me, but also a loss because I had to pay a lot of interest on her. But also, missed payments are also a very big thing as well. They will track how many times you missed a payment. Now, some companies have a little bit of leeway. They can wait up to like 2 weeks before you actually get hit with a late fee, and then that affects your credit. But credit reporting on like auto loans take about 30 days. So you can take a late fee on a credit card or on an auto loan before it will negatively impact your credit. So as long as you make your minimum payment every month, you're never going to have like a late fee, but you will accrue interest. Most likely not be able to pay it off for a very long time if you're only doing the minimum. But with auto loans, if you want to pay off an auto loan, the quickest way to do it, you make your minimum payment. Anything extra that you want to pay, put that on the principal side of the loan. So you're going to, no matter what, if you're going to pay for an auto loan, you are going to pay interest on that thing. When you make your minimum payment, it is taking the interest from it first. Anything left that is not paying interest will go towards the loan. Will go towards the actual balance of the loan. But if you want to pay extra and pay it down quicker, you put it on principal, because then that's eating away at the direct loan amount. Whereas some people will prepay, so that way it looks like they don't have to make another payment if they don't want to till 2030, but so they stop making payments. But you know what's still happening? Interest is still accruing on that thing. So next time they make a payment, it's going to be all interest, because they haven't been making any payments. Interest is still going to accrue on that thing no matter what. So that's why you always make your minimum payment. Anything extra, put it on principal. Now, credit cards, if you make a payment, it's going to go straight to principal. The only interest you're going to pay is when you see it on your statements, and then they add it on there. So it's always going to be principal, but it's going to slowly accrue just like an auto loan. Usually most auto loans have like a per diem, so how much interest is going to accrue every day, but that's going to change depending on how much you have on that car. So that's why you always want to put more money on the principal, because it's going to slowly chip away at that per diem. That's going to overall change depending on how much is on that loan. Now look, there's a whole other aspect of this, loans with home equities, that it's similar to auto loans, and it's similar to like credit cards in the aspect of you can just take money out whenever, but usually they have their minimum payments are usually based off of like 10%. So if you're going to take $10,000 out to get a water heater, just for an example, I don't know how much water heaters cost, but say you take $10,000 out, do a water heater, do some work on your house, right? It's going to have a minimum payment no matter what of 1%. So you're going to have to pay, your monthly payment is $100, but it slowly will chip away and slowly be smaller and smaller every time you make a payment, but the interest is going to still keep coming because it's a revolving credit. So those amounts are always going to be higher. Anything that they can't for sure know how much is going to be on that is always going to be higher. So credit cards, home and equities, line of credit, are always going to have a higher interest rate. Things like auto loans, personal loans will be higher than a credit card, or personal loans will always have a higher interest rate than a auto loan, because they have an asset. Say that you stop making payments, they're going to repo that car. That's why the auto loan could be a little bit cheaper. It's because they know what they get if you don't make those payments. Personal loans, where you're going to take the money out to do what? Like, it's kind of based off of credit score, how much you got in your accounts. You can take money out, but it's going to be significantly higher. Not going to be as high as a credit card, but will still be higher. Now, there's other ways to do things like CD secured loans. That's where you're pretty much borrowing your money against your CD, but then you get the money, but then the CD will still accrue interest, but depending on the interest rate of that CD is depending on how much the auto loan is. So if you're smart, say you put $10,000 in the CD with a very, very shitty interest rate, right? That means the CD secured loan is not going to be a high interest rate, because it's going to usually be based off of, say the CD is in a 2% interest rate, which nowadays very low, but never know, it could drop. which always occurs all the time. You never know when it's going to actually change. But say interest rate is at a 2% on the CD. Usually it's based off of, some places could be different, but say this place in particular is due at 2%. So no matter what the interest rate is on that CD, the interest on the loan is always going to be 2% higher. So you have a 4% interest rate on a loan for $10,000. 4% is incredible. We have not had that low of a rate since COVID. COVID was perfect if you wanted to get a loan because no one wanted to spend money. So everything was through the roof. CD rates were horrible. Interest rates were horrible. Well, interest rates were great. CD rates were horrible. That's one way to tell whether or not you're in a recession. Because if the CD rates are bad, that means the interest rates are really good. If the CD rates are great, that means the interest rates are horrible. They kind of go hand in hand. So that's why old people love when the world's kind of in shit, because interest rates are super high for their CDs, because all their money is in CDs. You got to remember that. A lot of old people put their money in CDs and they let the interest accrue off of it. And then they live off that money on the CDs. Now, during COVID, when interest rates were like 1%, they couldn't live off that. And they were pissed because they had to close out CDs and live off the actual money that they were living off of instead of the interest rate money that they had. They could throw a $75,000 CD in there, 5%, and then just every couple months take the interest out and just live off that with any other money that they had. That's how they were fine. But when everything is down interest rate wise, then they suffer too. But in a world where interest rates are really high, they are living it up because all they're doing, they don't have any loans. They don't have to worry about an auto loan. They don't have to worry about a home loan because they can just take the money out off that CD secured loan, have a 4% rate of $20,000, and then just buy the car outright. They don't have to worry that it's going to be a crazy rate like an auto loan where it's going to be 8% when they can just take a nosedive on $20,000 for a shitty interest rate that they're not going to get that much money off of, but have a really, really low CD rate. And then just use the money from the other CDs that they have, because they got more than one, and just slowly chip away at that money instead. You understand? This was way more than I was planning on talking about. I kind of rambled on about different things, but the main focus here is there are ways to use your money effectively. And I don't want to seem like this is not I don't want to say it's financial advice, because it's not. I don't have the ability to tell you it's financial advice. These are just tips that I've learned over the years that are beneficial to really anybody. Like, credit unions are great because of that, because they are nonprofits. Now, not every nonprofit is great. All right, just to be clear, there are bad apples in everything. I'm sure there are some nonprofits that make you go, that's a little scummy. And there are. But credit unions are great on that aspect of lower interest rates on loans, but higher interest rates on savings and CD accounts. So one way so I would always say consider a credit union, because you can actually use your money effectively, earn more money, and also they give back to the community. That Chase Bank in your town is not going to put on fundraisers. They're not going to give back to the community, donate to that community, because they have money they got to give to big bucks in Texas that has an oil rig and makes crazy money, but has all their other interests in that bank. Because at the end of the day, the bank will always focus on the shareholder, just like any other company in Wall Street. And I'm not saying that every country, and I'm not saying that every company on Wall Street is bad, but to eat the rich, you got to start on Wall Street. That's kind of it. I've talked way more than I thought. There are other things I want to talk about, not as politically charged as this. If you guys are interested, I would love to talk about other things, about all sorts of topics that I have learned over the years And sure, I could be wrong on plenty of things. I'm sure I could have been wrong on a lot of this. But at the same time, I want to have an open discussion, just discussing things. Like I don't want to seem like a white dude with a podcast, but I want to be able to discuss things that are happening in the world, things that are happening just in life, whether it's your personal life, not too personal because they don't want to have a parasocial relationship, but I'm rambling. I don't know. Let me know in the comments if you guys even made it this far, but otherwise I will see you guys later.